Good day. This is Jeffrey Christian from CPM Group. I'm speaking for the Denver Gold Group at its World Gold Forum, which is now a video presentation. The title of my presentation today is What's Going On. Denver Gold Group asked me to talk about some of the things that are being said about gold. And you can see from my subtitle that I think that there's a lot of nonsense about gold spot and future prices being decoupled. That's not exact at all what's going on. But I'm going to try to spend most of my day or presentation talking about the realities of the gold, silver, platinum, and palladium markets. What really are the overall trends in those markets. I want to go fast and I have a lot of ground to cover, but let me start by talking about the decoupling or lack thereof. Basically, spot gold and futures prices are not decoupling. What's happening is that you have a tremendous amount of gold. You have more gold in London vaults now than ever before. You have more gold in Swiss vaults than ever before. And frankly, you've got a tremendous amount of gold in New York and US vaults too. There is plenty of gold around. Part of what's going on is that London is a spot market. And over the last 2 years, you have seen historically low levels of gold and silver investment demand. A lot of investors have actually been selling their gold and silver. And when they sell it as spot physical metal, and that goes into the London and Zurich vaults and London and Zurich markets. As a result, you have a tremendous amount of metal that has built up in London and in Zurich, historic levels. At the same time, you've had a lot of financial strictures and constraints on the creditworthiness and the credit activity of the market participants. And you've had a situation where there hasn't been readily offsettable places to sell that metal as other people are selling it to the banks and bullion dealers. As a result, you've seen a lot of banks that are active as market makers in gold, buying physical gold in London, paying full price because it's a spot sale, so it's 100% of the value of that metal, storing the metal in London, and then turning around and hedging that with a short position. They're buying gold in London. They're hedging that with a short position on the COMEX futures market. COMEX futures market has liquidity and has continued to have liquidity. We saw this in 2008, 2009, when the over-the-counter market and the principal-to-principal contracts around the world were dried up because there was no credit available to the companies to trade, but the COMEX had a clearinghouse that allowed for trading. So you saw a surge of people selling gold and silver back then, as they have now, and you saw that gold and silver being hedged with COMEX futures. That is a trend that has really started about 20 years ago, around 2000, 2001, and it's continued. It accelerated during the Great Recession and global financial crisis, and then it has accelerated again now. Now, over the last 2 years, you've had very low physical demand for gold from investors and from investors for silver. You've seen about a 90% decline in silver purchases, physical silver purchases by investors from 2012 to 2018, 2019. You've seen about a 75% decline in physical demand from investors for gold at that time. That has caused financial constraints for wholesalers and retailers of investment products because their business has been off, the margins have been terrible, and they've been financially constrained. That was the situation that we saw in 2019. It's the situation that we saw in the first 2 months of 2020. Then the coronavirus problems hit and the lockdown started and the financial markets started to get extremely volatile and prices started rising for gold and silver initially. And you saw a tremendous amount of problems. And there were any number of investors who were selling their gold and silver. They were selling it because all of a sudden they had to come up with more collateral. or margins if it was a margined account, collateral if it wasn't a margined account. So all of a sudden you reduce your gold and silver. Also, other people were saying, gold has risen to the highest prices since 2011, 2012. I'm going to sell it. Same thing with silver. You saw some people selling into the move up toward $19, and then the prices came back off. You have a situation now where the physical market centered in London is extremely well supplied, and there's not a lot of demand for that. But the COMEX continues to have a large short position. In the April contract, it was 51 million ounces of April open interest in the beginning of March. That 51 million ounces had to roll forward or be closed out one way or another between the beginning of March or the beginning of April, or the dealers that were short ostensibly could deliver physical metal into it. Most of that was rolled forward. You now have 35 million ounces of open interest in the June contract, so you should expect to see that kind of volatility again in May as we approach the June contract. And you see a fair bit of open interest that's all rolled all the way into August. So this is going to continue for a long while. It's going to continue as long as the financial markets and global economy are constrained by the realities brought on by the coronavirus. So another thing the Denver Gold Group asked me to talk about was the world, the economy. Where are we? I'm going to run through 4 quick charts. This is a chart that we use, talks about the issues the factors that may be positive or negative for gold. The green balls are positive for gold. They tend to be negative for the world. It's the nature of gold, is a hedge against uncertainties of economic, political, or financial nature, or personal nature. And this is where we were in early June, before the prices of gold and silver started rising. We were seeing these bubbles grow in size. We were seeing them move from left to right. So their likely impact over the next 6 months or 12 months would be greater, but they weren't rising in that the probability of them occurring in the next 6 months were unlikely. That's where we were in June of 2019. And I think the gold price was below 1,400, if I remember correctly. This is our most recent assessment of the world. Bigger balls, new balls, closer, and they've moved up in probability. So if I go back to that previous slide, those risks were on a distant horizon. Now the horizon is on us, and we have new risks that have appeared in the last 9 months. And thus the gold price has actually moved very sharply. These were our economic projections for the world, developing countries and advanced economies over as of January. We were looking for slower growth in the advanced economies in 2020, 2021, but we were looking for a recession later, a large recession, but 2023, 2025. That's what we were thinking in January. These are our projections that we made today, which is the 14th of December, I should say. And they were made today because this morning the IMF released its revised long-term economic outlook for the next 2 years. And our view of the economic activity over the next 2 years is basically based on the IMF view. They are looking at a recession heavily in the developed countries, but also in the emerging and developing economies. They're looking for negative 1% growth in the emerging economies and like a negative 6.1% growth in the advanced economies over the course of this year. They're looking at the deepest recession since the Great Depression. Now, I should say that in the Great Depression, the negative GDP in the first 5 years was something on the order of negative 16%. So it's not at all like the Great Depression yet, but it is the largest and deepest recession that we've seen since the Great Depression. They're looking for a rebound in 2021, And then that's where their projections end. We still have a recession that we're projecting for 2023, 2024. It's somewhat milder. It may not be somewhat milder at the end of the day, but we think that you're going to continue to see an economy that, even if it does have this V-shaped recovery into 2021, you will have a lot of problems compounded by the financial, fiscal, and monetary efforts that have been taken to protect the world and national economies during the coronavirus, and that this is going to continue to keep the economy extremely volatile and extremely susceptible to renewed recessions and problems. Turning to gold, if I may. Let's see if my computer will advance. All right, let's see if we stay here. The gold price actually, my computer doesn't want to behave. The gold price has actually risen to the record levels that we saw back in 2011, 2012. A lot of folks in the gold market continue to talk about when is the gold price going to rise. So we've been talking about the stealth bull market in gold. It's actually at record levels. Our estimate is that the average might be 1640, 1650 this year. That compares to an annual average of 1670 at its peak in 2012. So we are looking at gold prices that basically are already at record levels, and we think that there's further upward movement. Now, going back to July and August of last year, when the gold price started to rise, and again, we can sort of see, excuse me, my computer seems to have had too much coffee today. In July and August, when the gold price started to rise, we had extremely low demand for physical gold and silver. Again, I talked about it earlier. What we saw in July and August was a rally in gold prices that was fueled by futures, options, forwards, and some gold ETF purchases. The same was going on in the silver market, but it was primarily shorter term, opportunistic, momentum-based traders and investors who were buying into gold that drove the prices up in July and August. And when that was done, the gold price came back off. And in September, October, November, and most of December, we saw the gold price sliding back below $1,500. Then in late December, it started to rise again. It rose very sharply in the first week of January after the US assassinated the Iranian general in Iraq. And then it rose even more sharply as the coronavirus thing. We have started to see, as of March and April, a return of some physical demand for gold by investors. But by and large, the rally that we had seen prior to March and April was fueled by futures, options, forwards, and ETFs. If you look at overall investment demand, the black bars are years in which it was more than 20 million ounces. The blue and bars are less than 20 million ounces, and the green bars are outliers. You'll see three red bars in 1970, 1972, and 1996, when investors were actually net sellers of physical gold. The important thing is that we saw this upward shift in the investment demand curve around 2002. And for about 10 years, you saw investors buying more gold, more investors in more parts of the world buying more gold at higher prices for a longer time than ever before in history. That lasted into 2012. And then we had investors starting to buy less than 20 million ounces. And the red line is the percentage change in gold prices on an annual average basis. You can see that when investors are buying fewer than 20 million ounces in a year, the gold price tends to be weak. And when they're buying more than 20 million ounces a year, the gold price tends to strengthen. Again, you can see these numbers are through 2020, and these numbers were constructed in February. We had investment demand come down to very low levels in 2018. They rose a little bit in 2019, but they were still below 20 million ounces. And we were projecting them to rise a little bit more in 2020. That now may be much higher depending on how the coronavirus and the economic and political consequences thereof shake out over the rest of this year. While investors pulled back in 2017, 2018, 2019, central banks took the opportunity to buy. Central banks are like investors in some ways. They buy gold as a form of investment, as a stock. They don't transform it into jewelry or electronics or other things, so it's not fabrication demand, it's stock demand. But central banks have a different profile. They have different reasons for buying and holding gold than investors. And they also are much more price sensitive than private investors. So when the price rises, if you look at the lower right-hand corner, when the price rises, they tend to buy less gold. And when the price falls, they tend to buy more gold, up until late last year. They are buying more gold. They're continuing to buy more gold. Our expectation is they'll buy a little bit less gold this year because their money is needed elsewhere. But there is a long-term position in which the central banks want to continue to buy gold and add gold as a portfolio diversifier in their monetary reserves. Now, you have to take that with a deep understanding of central bank monetary reserves. The dollar remains king. In the upper right-hand corner, you can see that monetary reserves, foreign exchange reserves, 62% of them are in US dollars. The euro has another 20% of monetary reserves, and everything else has less. 60% plus is in dollars. It has the liquidity that central banks want. If central banks want to move out of the dollar and diversify their monetary reserves, they're going to be buying euros, pounds, yen, Swiss franc, and other currencies. And that's going to have an inflationary impact on all of those countries. As a result, you cannot really make a rapid transition away from the dollar as the reserve, the de facto reserve currency. So it's going to be around for a while. You can see on the left-hand side chart that gold as a percentage of total central bank reserves have actually pretty much been flat, a little bit higher over the last decade. And then on the lower right-hand corner, you can see that even though central banks did sell about 100 million ounces of gold from the 1960s until 2005, because they allowed the gold price to float and it went from $35 an ounce to $1,900 an ounce and $1,770 as of today, that gold as a percentage of the value of their reserves has actually risen. And in the upper right-hand corner, left-hand corner, I have a little comment. It's not just central banks that have most of their money in dollars. About 75% of private financial wealth is denominated in dollars. So it continues to be a dollar world, even as gold gains some strength and central banks and private investors become more interested in gold. Briefly, gold supply will fall. The orange part is mine production. It will fall more sharply. A lot of people think that total supply will fall as sharply as mine production because, quite frankly, mine production is publicly available data for the most part. Most mining companies are public companies. They publish their production. They publish their expectations for future production, and people can estimate what it's going to be. The red part is secondary supply from scrap. Old jewelry, old electronics, processed scrap is excluded here, but it's old scrap. And of that, there's no public data. CPM Group has a proprietary data series, which we developed starting in 1980-81 when we were the Commodities Research Group at J. Aron. We have maintained that. And scrap will probably do greater or better than mine production over the next 10 years because the price of gold will be higher, because governments and communities around the world are doing a better job of recycling old electronic scrap. and because it's more readily price elastic. Mine production will fall because there's a lag between the price of gold and when those mining companies develop new mines. So it has a longer lead time, and we'll see a decline in gold production over the next several years as a result of the long period of lower prices from 2013 to 2019. But that will be offset to some extent by rising secondary recovery due to the higher prices and the fiscal stringencies. If you look at gold prices, the left-hand chart breaks down into the all-in sustaining costs, which fell. I mean, they rose very sharply during the bull market. As the price of gold fell, some mining companies slashed their costs wherever they could. The bottom part is sustaining costs, which are more easily slashable. You can cut back on your exploration, you could defer development, you can cut your capital costs more. The cash costs are much more sticky because those are things like energy, which you don't necessarily have control over, other supplies, and labor. And it's very difficult for some mining companies to go back to their workers and say, hey, the gold price is down, let's cut this. So cash costs are harder to cut. We saw a big reduction in sustaining costs during the period of falling gold prices. They were flat. Now they're starting to rise again. And the all-in sustaining costs are rising because both cash costs and sustaining costs are rising. We saw about a 27% decline from 2013 to 2016 in the all-in sustaining costs. And from 2016 till the third quarter of last year, it's up about 17%. So that's the cost structure. I want to talk about platinum and palladium briefly, and then silver, and we'll wrap up. The platinum market has been in a surplus for much of the past several decades. The big red strike in deficit in 2014 was the South African strike. And except for that and some problems in production in 2012, you've seen surpluses in the total supply of platinum, newly refined platinum, including coming from scrap, relative to fabrication demand. Some people will show you a deficit. They do that by throwing in dummy variables for investment demand and saying, oh, I look at my surplus deficit by including investment demand. But classic and proper commodities research looks at total supply of newly refined material relative to fabrication demand. And you exclude investment demand for a variety of reasons, including the fact that what you want to know is this market in a bullish position or a bearish position without investors wanting to come into the market. Platinum has been in a bearish position for much of the last 15, 20 years, and it shows in the price. Our expectation is those deficits, those surpluses continue for this year and the next couple of years, confounded by the recessionary conditions that you're going to see in the auto industry and other platinum using industries. But that by 2024, 2025, you may see a beginning of a period of large and persistent deficits in the platinum market. So the platinum price may rise sharply, but it may not rise sharply for another 5 or 6 years. The palladium market, big surpluses in the Audis. They've diminished, and over the last 6 or 7 years, it's been a very tight market. That too has been reflected in the price, which has gone from $500, $600, $700 an ounce to it's $2,100 today, but it got a lot higher earlier in the year. Our expectation is that those surpluses will resume. They're going to resume for a couple reasons. One is the recessions. Second one is the substitution as automakers go back into trimetallic catalysts that use platinum, palladium, and rhodium, reducing their palladium consumption requirements and increasing their platinum requirements. These are our expectations of future motive transportation propulsion systems. And it's probably too small for you to see, but one of the things that we think that has been bearish for platinum is that investors think that electric vehicles are going to quickly replace petroleum-based fuels, diesel and gasoline. That can't happen. There's not enough electricity. The grids in most countries aren't stable enough to deliver that electricity, even if you could produce it. And there's a massive infrastructure that's needed to build for factories to make the motors, the controllers, and other components for the automakers. And those industries tend to be smaller. A lot of them are privately owned as opposed to publicly traded companies, and they are credit constrained. So it's going to take a lot longer for us to get to a point where we're producing 20 or 30 million electric vehicles. Furthermore, there's a growing realization that electric vehicles are not all that clean, since the electricity still comes predominantly from hydrocarbons, primarily coal, but also natural gas to some extent. So we think that the transition away from petroleum-based fuels to something else is a really long-term transition. And over the next 10 years, it's hardly going to make a shake. It's going to be a marginal effect in reducing platinum, palladium, and rhodium demand from the auto industry, because by and large, most of the vehicles for the next 10 years, probably 90% or more, will continue to use three-way catalysts or platinum-bearing, PGM-bearing catalysts, and will continue to burn gasoline or diesel. Flip side is we don't expect fuel cells to have much of an impact in terms of motive transportation. There are a lot of stationary applications for fuel cells, and there are some fleet applications, airports and warehouses, forklifts and airport vehicles that might work. But the platinum industry, I started doing research in 1978 on platinum, and in 1980, the platinum industry was saying that by 1988, they'd be using 350,000 ounces a year in fuel cells. And they have consistently overestimated how much platinum would be used by fuel cells by a wide margin. Those little black bars at the bottom are actual uses. And that last bar of 350,000 ounces by the year 2030 was Anglo Platinum's estimate that they released in late 2019. We just don't see fuel cells being a major source of demand for platinum, partly because we don't think that fuel cells will be all that big of a industry, and also because the fuel cell industry is looking at other metals to substitute away from platinum. One chart on silver. This is the silver surplus and deficits. And we're very much concerned. I mentioned earlier, this is an 86% decline in physical demand from investors for silver between 2012 and 2018. It's up a little bit in 2019. We expect it to rise more in 2020. But the reality is that the pattern of investors surging into buying tremendous amounts of silver, 150, 200 million ounces, and then slowly walking away from this market as they're disillusioned by the fact that the price rose to $50 and then came off. The pattern is very similar to what we saw in the 1980s, and it's extremely worrisome to us that the silver investment community may walk away from silver the way they did in the 1990s. And you can see in the middle there, you had about a 15-year time when investors were net sellers of silver. Extremely problematic and worrisome, that's our view of silver. We do think that silver has some interesting attributes, but someone has to solve the conundrum of the fact that investors are buying far less silver than they used to, and then they need to if the silver price is going to strengthen. That's all I have. Thank you for your time. I hope you enjoy your time online at the Denver World Gold Forum, and I look forward to talking to you both online and in person in the not too distant future. Stay safe, keep your hands clean, and when the barber shops reopen, I'll see you there. Thank you.